All right, let's get some perspective now from Nicholas Sargen, Chief Investment Officer at Fort Washington Investment Advisors in Cincinnati. He helps manage more than $30 billion in assets. And let me just ask you about the continued upward trend of this market, Nick. I mean, how much longer do you go along with this, or does it make you a little skittish here as well?
Good question. I think, first of all, that it is fundamentally based, and what I mean by that, Matt, is we've had incredibly strong profit growth, and the encouraging thing about the fourth quarter is more of it now is starting to come from top-line growth as consumers have opened up their wallet book. So that's the fundamental support. But as you're suggesting, we've gone up in a straight line for 5 months, so I have to be prepared anywhere along the line you might get a pullback, and I thought maybe Egypt was going to be the catalyst for that, and so far not yet. But bottom line is the market can go higher, but I don't see us going in a straight line.
Is there an issue here? Do we run into a problem with the consumer? Because we've been talking about consumer spending here. Pretty impressive as far as the amount they're paying, but the amount they're getting paid isn't that impressive. The amount of jobs they have isn't that impressive. In fact, the last employment figure showed you how many people have just dropped out completely of the employment market, and we see consumer credit up $6 billion in the last month. I mean, is it a concern if Americans start going again on borrowing and buying binges even before they earn any money?
Well, certainly if that was the case. I think, Matt, though, I have a more sanguine view that, what we had been seeing was consumer spending, say, growing at 2%. That was kind of the story for most of last year. And then around the Christmas period, fourth quarter, it did jump to 4.5%. The saving rate came down somewhat. But what I would say is smooth that out. I think what we're on course for is consumer spending growth of 3 to 3.5% without, meaning that people are necessarily living beyond their means. So, fourth quarter is probably an exaggeration, but I do see an improving trend relative to the last 2 years.
Jud, let's bring you into this. Jud Pyle, portfolio manager at PEAK6 Advisors. He's at the Chicago Board Options Exchange. So nice little rally here, nice rally in stocks last week as well. But the volume, not so strong, Jud. Is that something to be kind of suspect of in terms of the moves we're seeing?
Well, I wouldn't be overly concerned about the volume today because it's Monday. Let's see how Tuesday, Wednesday, and Thursday play out. But what that does highlight is the fact that I think we're getting to the end of earnings season, and so you're seeing a little bit less activity, and now investors are going to have to turn their eyes back towards the macroeconomic environment instead of stock-specific things. So we had a lot of volume, obviously, over the last 3 weeks as companies were reporting their individual results. Now we're just taking a little bit of a breather because there's less company-specific news.
All right, hang on a second. I want to get more on a Bloomberg bulletin. Big Lots is looking at options, including a possible sale. They've hired Goldman Sachs to that extent. And Cristina Alesci here on set broke the story for us down at Bloomberg News. What's the story? I mean, Big Lots, I thought, hey, I haven't seen a lot of them in New York. They're from my hometown of Columbus, Ohio, and it's actually a $2.5 billion company, so not bad. How are they faring in this consumer comeback?
It's an explosion. This story is literally just breaking. So the M&A team and I are trying to get our arms around exactly what's going on. But, I mean, if you look at the retailers and what they've been doing lately, retailers have actually been a little bit on the upswing in the sense that investors are looking at this and saying, okay, we've seen the bottom of the consumer spending trough, if you will, and now, with confidence coming back into the economy, there's going to be some kind of upswing at some point. So this may be a good time to buy retailers. And as companies look internally and they say, you know what, maybe this is a good time to sell.
I mean, that's a good point. I mean, over the last year or so, we have seen a lot of activity in the retail environment. Does that say anything about the possible price we might get on a deal for this?
Yeah, they've been trailing other retailers, which could explain a little bit why they would be reviewing strategic options, just to get a sense of how much the valuation would come in at. I mean, this is a very, very preliminary situation here. We understand that this actually was just decided at the end of last week, so it's very new, very fresh, and it'll evolve over time. My feeling is probably they'll feel out the market, see what they can get for their company.
How much of it has to do with that? I mean, we've seen a lot more M&A at the beginning of this year. We saw a lot more M&A last year than in 08 and 09, obviously. How much of it is companies saying, you know what, this market is waking up. People are going out there looking for stuff. Let's just put ourselves on the block and see what we can get.
Yeah, and you pointed out an excellent you pointed out an excellent fact, which is the market capitalization is between 2.5 and 3 now. The stock has come up a little bit, but that is the sweet spot for private equity. They want to do deals in that range, so that opens up a whole other universe of buyers besides just strategics coming in and potentially taking over. You have the financial buyers who are looking in that range. More importantly, they have the financing now because the financing markets are open. So you've got those two culminating factors that could potentially make this deal happen very quickly.
Also, who doesn't want to be in Columbus, Ohio?
I don't know.
What a fantastic Midwestern city that is.
Okay.
The people there are just great. Cristina, thanks so much for breaking that story. Cristina Alesci from Bloomberg News. We are going to go back now to, well, continue, I guess, focusing on the M&A story, but go back over to Adam at the markets desk. Adam, you've been looking into the deals today, specifically Chesapeake Energy's plan to sell some of its natural gas assets.
Well, you know something? You and Nick were just talking about consumer debt, and of course, you see that also on the corporate side. Specifically, let me show you. This is the reasoning behind Chesapeake selling, or divesting, I should say, $5 billion in assets, selling that Fayetteville shale, among other things. Too much debt, all right? Look at the debt load here on Chesapeake. You go back in 2000, all right, they grew the business. They got it up here. Well, back in January, Aubrey McClendon, of course, chairman of Chesapeake, said he wants to cut debt by about 25%. Get it back down here, make the company more reasonable, easier to manage, lower the cost structure. But I guess, Nick, the question goes out to you. On the one hand, you can understand why a company like Chesapeake would do that, but if rates are low and you think that over the next year or two rates are going to go up, isn't this the time to borrow because the cheap money's out there? Take a little debt because you might actually need it down the road. Wouldn't that intuitively kind of make sense, Nick?
Oh, absolutely. You know, our call right now is the front end, the short rates obviously aren't moving because the Fed's on hold indefinitely, but we have, as you're suggesting, already seen a backup in Treasury yields. It's spilling over into the corporate market. I would say, you know, corporate yields are probably up 60, 70 basis points, whereas Treasuries may be up double that amount. But, you know, the other point on the consumer side, coming back to Matt's question to me, you know, how can they finance, you know, how can they continue with this? If I look at consumer debt service, so I'm including their interest and amortization payments, that ratio relative to their disposable income has improved dramatically, but the debt level has not come down as much. So again, I think that's one reason why the Fed's strategy of keep rates low as long as we can is still intact.
You know, Dom, I want to bring you back into this conversation as well, because we've got another strategist raising his estimates for the S&P 500. It seems like another week goes by and we get, you know, more and more folks who are bullish out there. To me, it makes me wonder if we're getting near a top. But anyway, what's UBS say?
Well, Carol, I mean, another day, another upgrade, like you said, right? This is actually our friend over at UBS, Jonathan Golub, a frequent guest on our show here. He's taken his estimates from 1325, which is a decent number, up 100 points to 1425. Now, if you look at what he's saying, it's two E's, right? It's earnings and economic data, the two E's we've been talking about for a while now. And basically, it's a reacceleration of what's happening. So if you look at what's going on here, he's saying overweight, like you guys said, tech, you know, financials, industrial. So something to look at. But, you know, Judd, I want to toss this out to you. Sector-wise, are those the outperformers, or have tech and financials, Judd, become a cliche about outperformers here?
You know, I think they've become a little bit of a cliche. What I want to look for, no matter what, even if I'm looking for like a tech company, I'd rather go, and I think this is part of the reason why we're seeing so many big cap stocks in favor now, is I'd rather look for something that has a dividend yield, because that's going to give you a little bit of protection. Also, as Nick pointed out, with Treasury yields, basically, even though we've had a run up in Treasury yields, they're still relatively low compared to the dividend yields that you can get on some of these stocks. But no matter what, whatever an investor's personal situation is, they've got to keep an eye out on, as you pointed out, if things run too much and get overbought, you got to get out of the way.
We got to run. Hey, Judd, thank you so much. Jud Pyle out there in Chicago, Nick Sargen, thanks again also for being with us.